Here's what's coming up on today's show.
And, you're going to have things that are cyclical. You're going to have times where silver is going to be rocking and rolling, man, making new highs. Then you're going to have other sectors of the market that's going to they're going to fall in favor and they're going to fall out of favor.
This is the Retire Happy podcast with John Amarino, a fiduciary financial advisor at Securus Financial in the San Diego area, and Thomas O'Connell, president of International Financial Advisory Group, Inc. in Parsippany, New Jersey. Together, they'll be keeping retirement happy from coast to coast.
Welcome back to another episode of the Retire Happy podcast. I'm your host on the West Coast, John Amarino, and I am joined by my host and good friend on the East Coast, Mr. Tom O'Connell. Tommy, happy December, buddy.
Happy December, John. Glad to see you again. Nice and frigid out here in the great Soviet state of New Jersey.
Well, here on the Cuban state of California, it's nice and warm.
Well, I'm Siberia, you're Cuba. There you go.
Yeah. So how have things been so far? You getting ready for the holidays?
Good. I'm very ready for the holiday. I'm looking forward to a little bit of R&R. So it's well needed and well deserved, I think, for all of us.
Yeah, I always like this time, especially with the kids and Santa and Christmas. We got our Santa photos at the Hotel Del last weekend, they do a great job. So yeah, and I'm ready for a little R&R too.
I see the elf on the shelf was at your house too.
Yep. He was molesting our lamp leg. God bless him.
There you go. You got to shoot your eye out, kid.
Yep. That's 20 Christmas Eve. That no one touches the TV. It stays on for 24 hours. Don't even bother. So, folks, with this being the last episode of 2025, we're doing what we did in 2024. And we are bringing on a phenomenal return guest. He is the founder of Catalyst Wealth Coaching. He is an investment mastermind and a mentor of mine, Mr. Joe Casey. And Joe is just, Tom and I sit in the retirement planning chair. Joe used to be there. He's a registered financial consultant, had a very successful retirement planning practice that he sold in 2020. And, Joe said, I'm going to retire until he said he couldn't. And, during his retirement, he decided to go to MIT and learn about crypto and technical analysis. And during that time, he started helping out a couple friends. And then he realized how he could, like so many of our guests, make a bigger impact in this world. And he's been coaching advisors for the last couple of years, including myself now for going on a year and a half. And this man is definitely been a blessing to my practice and my clients. And when it comes to markets, one of the most knowledgeable gentlemen in the industry. And I have learned so much about the markets in the last year, probably more in the last year than my previous over decade of experience. So without further ado, I would like to introduce you to today's guest, Mr. Joe Casey.
And today's guest, the founder of Catalyst Wealth Coaching, it's Joe Casey.
Hey, John, glad to be here today. Good to see you again, Tom, and looking forward to sharing today on today's show.
Thanks, Joe. Always great to see you.
Absolutely.
So, Joe, we talked last year about how you got into this space, but really quickly, talk about how you got back into this technical advice mentorship and why it's, you talked about this when we were in Kentucky, how I don't think you really ever thought about having your business build up in this space, but the impact you're making and how it's really kind of driving you to go bigger.
Absolutely. As you've already said, I sold my practice and I thought I was kind of out of financial services. And so during the pandemic, like many people, I was just utilizing opportunities and educating myself further about different investment classes like the crypto and so forth. And I started having friends ask about, hey, could you help me out a little bit with AUM about investing? And so from kind of that point, I started seeing the need that you know, guys that were in the trenches, they just needed a little bit more help when it came to the market. And so I started sharing some of my expertise, and quite remarkably, I discovered that this was a kind of a deficit in most financial advisors' kind of repertoire in a sense. They just didn't have the skills that they really needed when it come to investing in the market. And I personally believe that's by design. I believe that the markets are highly manipulated, and I think there's a lot of information that's just kept from the average financial advisor and guys like you that just there's something missing, and you're like, okay, I'm going to seek until I find what helps me do a better job for my clients. And ultimately, I realized how big of a opportunity this was for not only me helping guys and gals with their financial practices, but also impacting directly the clients as a result. And today I serve more clients through the advisors that's in my program than I ever did as a practicing advisor. So I'm very honored to help guys and gals build their financial business and do it the right way.
We talk a lot about, and you mentioned it almost right from the get-go, about market manipulation and news in the markets and stuff. If you don't mind, let's expand on that a little bit. Talk to us about your experience with that, and what you see going on, and why aren't we getting the type of information that we should be getting?
Absolutely. That's a great question, Tom. And I'll tell you, I don't mean to sound like a conspiracy theorist or anything, but maybe just a little. I believe that a lot of the information is manipulated when it comes right down to it. And when you see big firms, and I don't really want to mention any names, but when you see some of the bigger firms out there, they've got high net worth families. Ultimately, for you to sell something, someone has to buy it. And these big firms don't go out to the market and say, hey, everyone, the market is going to turn down. We believe there's going to be a crash. Apple's not looking favorable. Maybe this or that has come up negative, and we're wishing to sell out of our, however millions of positions of Apple that we have. That's not what they do. And what they do is they build narratives to where, let's just use Apple. Apple's a great investment, and that basically you see those things in the news, you see those things on Wall Street, and then what you'll find is you'll find that the institutional players are doing just the opposite of what the narrative is in the marketplace. And you're thinking, you're scratching your head, but wait a minute. I just saw these guys and heard these guys say this, but they're actually doing the opposite of what they're saying. There's something must be up here. And so as I began to witness those things, I started doing a lot of investigative searching, I guess you could call it. And I discovered that when these companies are aiming to sell or unload, they do so through market manipulation. And it's kind of, you've heard people laugh and say, well, I do so poorly at trading. If I would just do the opposite of what trades I take, I would do better. And there's so much truth to that, where people get caught up in their emotions. They get caught up in the narrative that Wall Street's painting, that they end up doing poorly with their investments. That's why having a strong plan and managing that downside and managing your risk is uber important. And if you've got an advisor that actually knows really how to do this, and how to manage assets, how to stay on the right side of the market, then you've got one heck of an advisor, I'll tell you.
One of the things that John and I talk about all the time, and I typically say this to clients, is if you're hearing the news, you're hearing it too late, right?
Yes.
Or if you're hearing about something, it's already happened. And a perfect example, I think, between John and I was, he and I were talking about silver and gold easily 4 or 5 years ago. right?
Yeah.
So silver was at $15 an ounce, gold at, maybe 1,000.
17.
And right, and we were in there recommending it, in small amounts to clients as part of the inflationary hedge for the portfolio. And nobody was talking about it. There are a couple people, Robert Kiyosaki and maybe a couple other people. That's one of the things that I think about. To your point, is once the general public hears about it, it's too late.
It's too late. And I've seen that over and over and over. And so that's where, if you're not careful, FOMO will get the best of you. And usually when you see something that's just, oh my God, I can't believe this thing's going to keep going and going. About that time is usually when it's running out of gas. That's when I feel those emotions rising inside of me. I always take a step back because I know if I follow that thought on, I'm probably going to make a mistake because the markets are so manipulated. And here's the thing, you don't have to be afraid of that. You just have to know it, and you have to get on the right side of things. That's the real key to it.
Yeah, and you mentioned the manipulation. I talk to clients about how the big Wall Street machine has spent billions knowing how we think,
Yeah.
how we act. I mean, they've done studies. Dalbar's a great example of it. Not saying that they're in tight, in connection with each other, but Dalbar studies behavioral finance. Behavioral finance is a big part, and also programming. Right? I talk to clients and say, listen, when you turn on Fox or CNBC or MSNBC, whatever you're watching, why do you have to have the S&P 500, the Dow Jones, and the Nasdaq in that corner staring at you for an hour? It's to get you excited, or like you say, and I love the term FOMO because that's a very legitimate term, or it's to get you freaked out. And one thing that I always suspected, but you really hammered home in your training is, listen, the manipulators always have a setup to make money on the top and the bottom. They're just going to push your buttons to get you to move.
That's right. When you see the markets moving, you have to kind of have to always come back to your plan of action. You've got to come back to your overall objectives. What are you really trying to accomplish? And salt and pepper and in like silver, like you have been doing. That was a smart move. And you don't want to wait till silver is at an all-time high to start buying in. Buying in before the big moves happen sometimes is incredibly hard, but other times it's fairly easy if you know what you're looking for. And obviously that's why all of our disclosures always say past performance is no guarantee of future results. Is because in so many ways the moves are already over by the time Main Street kind of hears about it. And so if you go into a move expecting it to do what it just has already done, you could be very disappointed. But there's always the next move. There's always the next position. And see, I think a financial advisor, your goal is not to be a CFA or CMT and be a technical guru, but you should at least know the basics of the market and know how to navigate markets. And I think that's where our training comes in really spot on. It teaches guys how to stay on the right side of the market, keep their clients on the right side, because that's the most important. And you're going to have things that are cyclical. You're going to have times where silver is going to be rocking and a rolling, man, making new highs. Then you're going to have other sectors of the market that's going to they're going to fall in favor and they're going to fall out of favor. And really the key is understanding those rotations and actually being able to say, yes, this is a brand new trend. This trend's actually underway. Let's climb aboard this. And then on the same side of that coin, looking at it and saying, hey, this is a poor time to get into this. It's already made its high. Let's not touch this because how much higher can it really go?
So with that, Joe, no one has a crystal ball, but in learning it, and you say basic, I think that's you humbly speaking. I think what you teach is very advanced, and the knowledge that when we were just in Kentucky for 3 days nonstop. And that wasn't your typical financial advisors conference. It was down to business from 8 to 5. And you're showing though that while there is no crystal ball, that tendencies there's a tendency for market moves to repeat themselves and to have certain patterns. And one of them that I love, but they're very hard for people to spot unless they're like you, is a cup and handle. And I remember in one of the trainings where you literally said, "Listen, this price is going to go up to this exact spot here, and then I'm going to sell and take profits because it's going to drop down." And sure enough, it did. Can you talk just a little bit about the repetitiveness of the market and trends?
Absolutely. In technical analysis, trends are something that is pretty identifiable if you actually know how to spot the trends. But what's the most important, I think, for people to understand about trends is it's where the price is continually going higher or continually going lower, because you can have the uptrends or the downtrends. There is a third trend in there, and it's called sideways. Well, you don't want to really do much with a sideways market. It's more of an uptrend is what most of your clients are going to be interested in. And I think the real key in identifying trends is having a framework in place to be able to do it. And so if you're a financial advisor and number one, you understand trends, number two, you have a framework to identify trends, then it's going to make your entries into the market much cleaner. It's going to create better results for your clients. So, way back in the day, I used to have my financial practice. I didn't know this. And so you had Mr. and Mrs. Jones come in. They said, "Hey, Joe, I'm going to hire you as an advisor." And you see, my job, Tom, was to deploy their assets in the market. Well, if I didn't understand what a trend was, I had no idea what this even kind of boiled down to, then I'm going to just kind of randomly release Mr. and Mrs. Jones's assets into the market. Well, how do I know where I'm at in the market if I don't know what the trends are? Are we in the top of a 2008 market? Are we in the top of a 2000s market? Because if I deployed their assets right then, and I don't understand that the market's in a transition to a downtrend, Mr. and Mrs. Jones could lose a significant amount of money. And there's so many advisors that just simply lack this information. They don't understand that. And so just like 2008, we had a massive downtrend. But eventually that trend ran out. It kind of found its bottom, and we started a new uptrend. And there's certain markers that obviously we can't get into it here, but in our training, we've taught guys how to find those specific markers that say now we are in a new uptrend. And obviously the earlier into a trend, the better. And so for example, by just analyzing the S&P and just knowing where the trend is, gives you as an advisor a huge tactical advantage. And plus it ultimately comes down to your clients, and it provides your clients with a tactical type of management, which is absolutely fantastic. If you have a financial advisor that understands trend, like I said, you're a lucky investor.
When I hear you say trend, one of the synonyms in my mind that comes up is profits. And I guess maybe, I don't know, are you saying, hey, don't be afraid to take a profit? Because I find that a lot of people and Wall Street, they're not proponents of you taking profits unless they can make some money off that trade off of you, right? One of the things I always try to tell people is, look, in your mind, you should have a dollar amount or a percentage amount that you're happy with making. Because like you said earlier, there's always another deal. And
Right.
That's what we have to look forward to.
That's exactly right. And, you've heard the old adage, buy low, sell high. The problem is people don't know when to sell high. And so there's this kind of openness, like, okay, we're just going to sit back and we're just going to kind of let the sell be out there somewhere in the distant future. Well, that's okay if you're young. Like I've got kids that my oldest is 20. And so dollar cost averaging into some good, index funds, some good ETFs, that's a different story. But when you get closer to retirement age, 55, 60, 65, that may be right around the corner. And what I find happening is a lot of times people do very well in the market, but they turn around and give it all mostly back. And most I don't I guess I shouldn't say most, but many investors end up with a very lackluster return because their advisor reacts pretty much after it's too late. And I find a lot of times advisors they're very emotional in their response. And that's where having a good solid system in place, like we're getting ready to go into 2026. Having a good system in place will help keep you in the market longer, and it will tell you where the trends are changing. And that's really what you're trying to do as an advisor and as an investor. You're not simply trying to time the market. You're not trying to get a certain percentage out of the market. You're simply trying to align with the market. And if it's changing hands from a bullish market to a bearish market, you want to make that change along with it. So that way it maximizes your returns. And you're not one of those investors that make a great, nice return, but turn around and give a big percentage of it back. Again, if you're 20 years old, doesn't matter if the market corrects or not. Eventually, it's going to work out in your favor because you got many years to go. But if you're 60 years old, I mean, a downturn in the market could be the kiss of death.
Yeah. So, Joe, you were talking about the uptrend and the downtrend, and then you mentioned sideways, and or as the technical term, price house. And just on this week's charts that I was listening to this morning, you're talking about how we're in a price home, and we were in a price home last year at this time. So, two-part question. Number one, can you explain what a price home is and how it's difficult to invest in, and what do you see going forward, at least in the short term? Will we have a Santa rally?
Sure. Well, if you look at last year, somewhere around Thanksgiving or so, we entered into a price home. This is a consolidation area, and prices really never got above about 6,100 on the S&P, and it just kind of oscillated between about 5,800 to 6,100, and that went on really right up until March. About March 1st, March 2nd, we actually broke that 5,800 level. And of course, that was part of the tariff sell-off. And so for literally almost 3 months, the market was sideways in that consolidation. The great thing about that is we know where it's at. We know it's in a price zone. We know where price is at. And at that point, we simply are looking for the breakout. We're looking for price to either break out the top or break out the bottom. And so currently, if we take a look at the market now, going back to October, we made a low there about 6,500, and then we've made a high of about 6,900. And right now, price is kind of just oscillating between those two numbers of about 69 to about 65. And so just this morning, we've seen price reject off of that level, that 68 level, and now is coming back down. If this price level holds right here, this will confirm our price home. Now, what does that mean for us as investors? Well, when does price break these two levels? That's what we're going to really be paying attention to. Now, will it do the same thing it did last year? Will it break to the downside? Well, it very well could. I mean, nobody has a crystal ball. We don't know what direction market's going to go. And simply it comes back to where's our buyers and sellers. If we've got more buyers, well, guess what? The market's going to break the upside of that price home and continue trending higher. If we have less buyers and more sellers, then the opposite's going to take place. And see, as a financial advisor, you want to know this information because this is going to be very crucial when your clients sit down with you and they hire you in full confidence that you're going to guide their retirement. You need to know this framework so you properly set the expectations with your clients and you properly enter them into the market. And really, that's going to be the real trick of it.
So do you, I guess we'll talk about a little bit longer term prognosis in a second, but we're 2 days away from a possible federal rate cut, your confidence in that, and do you think that the market's built that into the pricing today?
I think a lot of it is built into the pricing. If we take a look at the 10-year Treasury, you can see that the Treasury is down a little bit in comparison to like the S&P 500, and often the bond market, the yields go up, it puts pressure on the actual stock market. And so basically, if the Fed, if they cut rates or they raise rates, that could definitely have a direct effect on investor sentiment. What the crowd is doing. Will they see that as a kind of a threat, and we'll see a temporary sell off? Again, we've got what, it's setting around 6,800 right now. 6,500, we've got 300 points. We could see the S&P sell off, hitting that basic support zone. So that would fall right in line with our price home. So I think it's Wednesday. If the Fed comes out, they lower rates, I could see the market responding very positively and seeing us potentially break this price home, to break the 6,800 level, going into the 69 to $7,000 on the S&P. Now, if it kind of stays the same, then I could see this where maybe there's not a lot of movement. Maybe that's priced in already, and you're not going to see very much, but a continuation of this sideways move. Now, like I said earlier, we want to see the markets going higher because that means our accounts are growing, but it's not a bad thing to see price stuck in a price home, because that tells me as an advisor where price is at, because I know exactly what it's going to do next. I don't have a crystal ball, but I know exactly what it's going to do next, if that makes any sense. It's going to break either to the high or it's going to break to the low.
So with that, and I apologize because I'm going to use a little bit of a technical term here, but a big thing in the technical world that's been talked about a lot is breadth. And we've talked about market breadth. Can you talk to the audience about what market breadth is and why it's important that we understand it as investment analysts?
Yeah, it's a tool that it helps us look at the larger movements, the more of like an advanced and decline. So breadth indicators simply give you more insight into the broader participation. If you've got like the Mag 7, if you got the mega cap stocks kind of jerking price around, that could create some artificial movements. And so if the markets go higher, but then snap lower, and you find out later, well, that was just because, 3 or 4 of the mega cap stocks, was pushed up or pushed down. And a lot of these bigger companies, they will manipulate these bigger mega caps. And so it's important to look at the breadth of the market, simply gaining of understanding. Is there a small participation, or is there a broader participation? And the great thing is there's indicators that we watch that gives us that very thing. It tells us if we have a smaller participation. Do we have the Mag 7 stocks moving the price around on the S&P, the Dow, the NASDAQ, or is there a broad market participation? I think that to me is incredibly important, because I would rather see the market move up with a broader participation. When markets move and there's a small participation, it's the Mag 7s or the mega cap stocks, then is that going to hold? Or is this just a temporary, does it create the FOMO? Does advisors rush in with clients' assets and put them in the market only to wake up a couple weeks later and find out, wow, this didn't go anywhere but down, and now we're in the red? And so I think it's important that you at least reference the broad markets versus, kind of those smaller Mag 7 type companies.
So you mentioned the Mag 7 companies, but where do these algorithms come into play in market movements as well? With these big ETFs and mutual fund companies and private equity companies, it always seems more so at the end of the day, there's a big movement one way or the other in the market because I guess maybe all of a sudden these algorithms are telling the computer, hey, you got to buy or you got to sell. Is that something that we can pinpoint as a market mover or important to know about?
Well, there's definitely a lot of benefits to algorithms, and there's one algorithm I'm very familiar with, and what this algorithm does is it looks at the filings of like ETFs and these different companies, and its main job is to locate companies that have performed a certain amount over the last little bit and kind of put them in the front of the line to basically average assets into or rotate into. And sometimes you're going to see that on a massive scale because there's a lot of companies using a very similar algorithm. And so I think that those are just good fundamental ways to invest. But there is such a thing called dark pools, and dark pools are very legal pools of investments that big institutions will hide their orders behind because like for example, Tom, if you knew Schwab or Fidelity or somebody like that was about to buy Apple and they were going to put $50 million in Apple, well, it'd be great to get in the front of that, right? Well, they use these dark pools to actually buy positions that's kind of filtered out over a period of days so that investors can't kind of get in front of those orders. And those dark pools are very legal, but the algorithmic types of trading, the dark pools, those types of things can be seen in the markets through volume. Volume cannot be hidden. It can't, it's there. Anybody can see it. And so we give a lot of weight to volume. If you've got unusual volume coming in to a market, then most likely you're going to see that security move either up or down. And so being able to see those larger algorithmic type tradings or those dark pool trading, that is something that's super important because when you see it, again, it's just like the price of it tells you where things are at. And when you see a breakout, for example, if we get a breakout from this current price home and we've got above normal volume, then that's a huge sign to me that you've got algo companies, you've got dark pools, you've got a broad participation on this move, just like what we saw when the tariffs sold off. There was one day there, it was April 9th. That was probably the largest single move in one day that we had seen in a long, long time. And so to see the volume come into a market the way it came in on April 9th and the size of the move that came as a result, that right there tells you a lot of information. And so that told us as advisors, as investors, that there was not only buying the dip there, but we quite possibly was at a bottom. And honestly, we hit a couple other key framework levels that signaled that we potentially was putting a bottom in right there around that first week of April. So you had every kind of algorithmic company, every kind of dark pool, everybody that could be climbing on that move over the next 2 or 3 weeks based on that level of volume coming in. So I don't know if that fully answered your question, but hopefully it did.
Yeah.
Well, I mean, one thing it hammers home is, if you're a do-it-yourself investor and you just have your Fidelity account, the seismic advantage that your opponent has over you is tremendous. I mean, even for people with resources like Joe and I have at our disposal with, the trading resources, the backs are up against the wall. So, I always tell people, if you're a do-it-yourself investor, you've got to really, and you're going to do it in retirement, that's fine. But you need to treat it like it's a job because, like you said, that's your livelihood. You just can't accept a huge loss on a buy and hold strategy.
Exactly. And that's why a lot of people don't do very well, do-it-yourselfers. And you've heard the stories of folks, retiring, they've got a lump sum of money, they do it themselves and they lose a significant part of it. a lot of guys, I think that they know that many financial advisors don't have a real good reading on the markets and things, and they just want to attempt to do better. But honey, I got to tell you, if the financial advisor's struggling, and that's his career and profession, you coming in as a do-it-yourselfer is going to have a hard time. And so it's not to say you can't do it, and it's not to say you didn't educate yourself and become fully aware of what you need to do, but it's a long journey to get there. The biggest and the greatest decision you'll ever make in your retirement planning is the advisor you're going to hire. Bottom line. And that advisor ability, it's not, always kind of got concerned when people were always trying to find the cheapest advisor. I don't want the cheapest advisor. I want a guy that's got ability. I want a guy that I know that he knows what's going on. I want to follow that guy and I want to pay him well. It's kind of like I used to be a builder years ago, and we did a lot of, contract work. And, it always amazed me when people tried to get the cheapest carpenter in to do a fantastic job. You never want the cheapest carpenter. You want the guy in the middle of the road, a guy that, number one, you don't want to beat him down on price because that's going to directly affect how he's going to do his job. And so to me, finding an advisor, it's got a great ability and not necessarily nailing the tops or nailing the bottoms, but simply aligning with the market is the real key there. It's just like in 22 when the market had peaked in 21 and we turned the page into 2022, the market trended down for 10 months. Well, many advisors didn't wake up to the fact the market was in a bearish market until literally the market had already moved down tremendously. The guys in our program, they caught wind of this early on in January, going into February, that the markets was changing hands. And it's simply because of the structure of the market. The structure gave the advisor the framework, and all he had to do was follow suit to what the framework was telling him. And the market just has a language. That language can be interpreted, and it really results in buyers and sellers, supply and demand. And that's really the biggest key, is keeping yourself on the right side by simply identifying who's in control. Is it the buyers or is it the sellers?
Yeah, one of the things that you said again towards the beginning, and one of the things that I think John and I both preach as professionals is we're not trying to get you in the market and reaching that ultimate high, right? What we're trying to do is make you a good profit and protect you on that downside, because that downside is way worse than, trying to max out at that top side. I always say to people, the minute you lose $1, you can never make that back because of the compounding effect that dollar could have had going into the future had it kept growing, right? Yeah. Now, I maybe I'm overdoing it a little bit for people, but that's that's one of the things that you had said real early, which I think is important, is you always have to protect on that downside.
It's the greatest thing that you can do. Like when guys come into our day trading program, the first 3 months is, we're not really investing. We're getting things kind of worked out to where if you are day trading, which, some people are good at it, some people's not, the number one thing you've got to realize is the capital preservation, the risk management is what leads the ship on day trading. And when you move into longer term investing, the risks are still there. You still have to lead with good risk management. And ultimately, that's what a good program is going to do, is in terms of investing, is it's going to always be mindful of the risk. It's always going to put the risk management first above what the return is. Because if you take a large drawdown, I mean, look at the last big drawdown we had in the S&P, the tariff sell-off. Well, there was a lot of advisors, and I kid you not, there was a lot of advisors that sold their clients out after the market had made a significant move down. I think the bottom was put in April 7th, and they literally sold their clients out on April 3rd. And so they eventually bought back in, but it was like up into June, August, and that was horrific. And and I spoke with them. They said, Joe, I didn't know how much further it was going to go down. Our clients were calling, and see, they didn't have a framework. They did not have a system by which to, look at things in the market. We had taken some assets out of the equities focus and repositioned them to fixed income back in December of 24. And then we made another rotation in February of 25. And then the market sells off. We averaged the first 10% back from the fixed income back to the equities on April 8th, because that's when we hit a key framework level. But see, that's the difference in having a system versus not having a system. And it really comes down to, if you're going to hire a financial advisor, the greatest decision you're going to make in your retirement planning is the guy or gal that you hire. And for you to figure out what to do in the market after you've already worked a career, it's not impossible, but it's sure is an uphill battle. So it's super important that, as you're evaluating who's going to walk with you on this journey, you may like the advisor and you may not like the advisor, but the one thing you better get right is, do they actually know what they're doing? And that's not based upon, well, I've got this client this amount of performance or that amount of performance, because any old squirrel can find a nut in a field somewhere. You can get lucky in the market and get a huge performance reading, but have a clue of what you're doing. And so it's more important that you find an advisor that knows how to manage the risk and knows when to step out of the way, take a little bit more fixed income, and get out of the way of a freight train. That's more important than trying to squeeze out, a percentage out of the trend in the market.
Yeah, and what I'd like to do, Joe, is kind of just close with my journey, because it ties into Joe. Tom, what, 2 podcasts ago, we had a guest on from American College, and both Tom and I have spent countless hours educating ourselves, getting designations, and really being at the tip of the spear to give our clients the best planning we can be. And in the last year and a half, I have learned so much, and the amount of education. I mean, Joe, how many modules are on the 2 programs that advisors, before I got in the inner circle, just the AUM and 6 figure, how many modules are we looking at there?
Probably looking, I'd say at least 60 to 80.
Yeah. And so every morning I was watching multiple, modules on the webinar, and it didn't click. I struggled a little bit earlier in this year. Joe was helping me out. I did a good. I did my clients right on the downside, but a couple of things I've learned is, my clients are no longer in a buy and hope. It's not buy and then just, hope for the best, and when the worst comes, hope it's not as bad as they say it could potentially be. You've also taught me, and Tom alluded to this, is how and when to take profits and to have a disciplined system. And you talked about this, have disciplined rules that when you're feeling emotional, you read the rules and you follow the rules. And, you took a lot of feedback and struggles of newer advisors, and you brought out some phenomenal charting in what, late August. And for me, that's been the game changer, seeing everything on those screens and actually sitting down with my clients, and my clients seeing these charts and understanding that we're not going to get it right all the time. No one is, not even the most successful, investor champions. I think they say they get it right half the time. But when we can limit our losses, like you say, and then on the times we get it right, and getting it right is not always at the bottom. You often talk about the bottom, it goes up in that first wave, let it come back down, and then that third wave, go up. And knowing how to cut your losses. And I'm a big country music fan, and something I tell my clients all the time is, I'm like the George Strait song. I'm not here for a long time. I'm here for a good time. And, when my clients have seen, they've seen the profit levels, and we talked about this in September, how we had phenomenal returns. And now the sideways market, it's, we're kind of just making moves and now, but like you said, the market goes up and it goes down. So you're just kind of a little bit stuck there. But my clients understand, and they're seeing the moves, and they know that behind the scenes we're doing a lot of work, and they've actually asked me like, how are you doing all this work? And I credit you, Joe, for your system, for teaching me how to quickly scan the markets, for the algorithms you've built into your proprietary programs that have shown it. And I show my clients, listen, we had a phenomenal stock that we bought and we followed Joe's system to a T. And we took profits. We reduced it from a 3% allocation down to a 1, and then it had a big 3% loss in one day, and we sold out of the rest of that position, not because of that loss, but because your algorithms and your proprietary program said it's time to get out of this position. And since then, even though it's a fundamentally phenomenal stock, I think on one fundamental analysis website, it gets a 4.98 out of 5. This stock had dropped over 30% in 1 month. And I'm able to tell my clients, we avoided that. We didn't buy and hold, we avoided that. So, I just want to close by thanking you for all your knowledge. You spend a lot of time, and we talk multiple times throughout the week. We spend hours on calls, and the impact you're having. And I think that's a common theme, Tom, you can agree with, is we look for guests that are looking to spread and cast their net out,
Sure.
and to not just impact a few lives, but to impact, understanding that if they can impact the centers of influence, the tax advisors, the financial planners, that net can spread out wide. And it is the Joe Casey's, the Dean Zayeds of this world. And I just want to thank you for everything you do.
You're welcome. Thank you for being a member, and I've been very happy to help you and many other advisors build out this part of their business, because I find it very, very important, very important, and I feel like it's a missing ingredient in many ways. And I get up every week with the ambition of helping folks out in this particular area.
Yeah, I mean, Joe, when you were in your private practice, you probably helped out hundreds, and now it's literally in the thousand because of that being that center of influence and helping out the advisors who have the hundreds of clients. And so, John helps me a lot with this because of all the information and all the material that you've taught him. So I have a lot to be thankful for you too as well.
Yeah,
So I just want to throw that out there.
yeah, yeah, that's awesome.
So, folks, if you're out there and you're trying to do this on yourself, or if you're an advisor and you're a fan of our podcast, God bless you. Joe, how can advisors get your help?
Well, we don't do a whole lot of advertising or anything. We simply, usually it's just word of mouth, but if you're an advisor and you're listening to this, you can first start off going to our website, catalystwealthcoaching.com. There, you'll learn a little bit about us, a little bit about our programs. You can watch a webinar. You can check us out. We don't manage any assets or anything like that for nobody. Primarily deal with financial advisors. So by all means, go to our website, catalystwealthcoaching.com, and just check out things and get in touch with us. If you'd like to proceed further, we'd be happy to set up a call and kind of go over what we have to offer.
And I will say this, if you're an advisor and you're looking out, Joe just doesn't take any advisor. He's gonna put you through the ringer a little bit and make sure you're willing to put the work in. So,
Yeah.
Joe, thank you very much for coming on the last show of 2025. And I just look, no matter what the markets do, I look forward to what the future has for my clients and our group collectively.
Yeah. Thank you for having me.
Appreciate it. One last prediction: market goes up 107% next year. Is that what I heard you say?
Oh, you never know what the market might do. I don't think we're quite done with this trend, so only time will tell. If I was guessing, I would say we'll go on to make higher highs. And so, but here's at the end of the day, we're going to do we're going to align ourselves with what the market's doing. And so, but,
Awesome.
Yeah.
Thanks.
So, folks, that wraps up another episode and another year of the Retire Happy podcast. Tommy, I love doing these podcasts, and I think you really took over a lot of burden. You got a ton of guests this year, and I thank you for your friendship and doing all you do for the podcast. And I wish everybody on this a happy and safe New Year, a Merry Christmas, a Happy Hanukkah, and looking forward to what 2026 brings our clients, our listeners, and this podcast. God bless everybody.
It's easy to get in touch with John and Thomas. If you're more on the West Coast, give John a call at 858-758-9889. That's 858-758-9889. Or go online to GoSecurus.com. That's GoSecurus.com. If you're more of an East Coaster, then call Thomas, 973-394-0623. That's 973-394-0623. And online at internationalfinancial.com. That's internationalfinancial.com. And you can, of course, always just check the description of today's show for all that contact information. Don't forget to subscribe and follow the podcast on your favorite apps, and we'll see you next time on the Retire Happy Podcast.
Investment advisory services offered through Brookstone Capital Management, LLC, BCM, a registered investment advisor. BCM, Securus Financial, and International Financial Advisory Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by John Amarino, Thomas O'Connell, and guests on this show are their own, and are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk, and unless otherwise stated, are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives, and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it is suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to the subjects covered. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosure of any conflicts of interest. Please refer to our firm brochure, the ADV 2A Item 4, for additional information.